Welcome back to the Financial Autonomy Podcast. My name's Paul Benson, financial planner and practice principal at Guidance Financial Services. Stock market returns were phenomenal in 2024, but strong returns can plant the seed for an unexpected risk. This risk is known as recency bias. Holding an awareness of recency bias is the best way of ensuring that you don't fall victim to its draw. So this week, let's take a look at this often overlooked risk factor. Well, let's start with what is recency bias. Recency bias is a cognitive bias that causes people to place too much importance on recent events, often at the expense of longer-term trends or historical data. This tendency can lead to overreactions or misguided decisions because the human brain naturally prioritizes what is fresh in our memory. For example, if you've recently experienced a period of strong returns in the stock market, as we just have, you might start to believe that these gains will continue indefinitely. Conversely, if the market has been through a rough patch, you may feel overly pessimistic and make rash decisions like pulling out of investments at the wrong time. So, how does recency bias show up in financial decisions? Well, it can sneak into your financial life in several ways. I've got a few examples for you here. So one is overreacting to market corrections. When markets experience a sharp decline, as they inevitably do from time to time, recency bias can trick you into thinking that the downturn will last forever. This leads many investors to sell out of fear, locking in losses and missing the eventual recovery. For Australians who lived through events like the 2008 global financial crisis or the COVID-19 market crash, these reactions might feel justified in the moment, but history consistently shows that markets recover, and if you sell, you've cost yourself a lot of money. Another example can be chasing hot investments. So on the flip side, when a particular asset class or investment performs exceptionally well, people tend to jump on the bandwagon. Think particularly if there was the stock market boom in the late 1990s, or perhaps more recently, the Bitcoin bubble, which kind of comes and goes a little bit. Investing based solely on recent performance often results in buying high and, unfortunately, selling low when the bubble bursts. Another example is changing spending habits. So recency bias isn't just limited to investing. If you've recently received a pay rise, you might start spending more freely, assuming that higher income is here to stay. We sometimes call this lifestyle inflation. It can become a trap where you end up in a role you dislike, but fear exiting because your inflated living costs demand the high salary that the role pays. And a final example is underestimating risks. During periods of economic stability, people might downplay the importance of things like emergency funds or having adequate insurance coverage. Recency bias can lead to a false sense of security that may be shattered by unforeseen events like a job loss or a health crisis. All right, so hopefully now you've got a sense of what recency bias is all about. What can we do strategy-wise to protect against it? So first and foremost, it's having that awareness, but here's a few practical strategy options that you might want to think about. So firstly, ensure that you keep a focus on your long-term plan. So a well-thought-out financial plan is your best defense against knee-jerk type reactions. Set clear goals for your investments and stick to them, regardless of what's happening in the short term. So for example, if your aim is to retire at 60 with a certain level of income, keep that objective front and centre when making your decisions. Next, diversify and importantly rebalance your portfolio. So we know that diversification reduces risk. By spreading our investments across different asset classes and geographic regions, we're less exposed to investment cycles. But over time, our allocations can get out of whack. In 2024, that might have been that your US share exposure is now higher than you had originally intended. Consider rebalancing back to your target allocation as a way to manage and control risk. It's also worth revisiting historical data. When tempted to make a decision based on recent events, take a step back and look at the bigger picture. Long-term returns from stock market investment is likely to be around 8%. Use this as your reference point, not whatever the return was in the past year. Another way to go is to automate your investments. And of course, via superannuation, there's a degree of that we all have, whether we like it or not, but it definitely works in our favour. But beyond that automated super contributions, think about whether there are other automated investments that you could be doing, whether that be salary sacrificing to super or an investment portfolio outside of super. Automating your investments can help remove emotion from the equation. Dollar cost averaging, which is what that normal automation is, a fixed amount being invested on a regular basis, it ensures that you're buying both when markets are up and down, which averages your costs over time. And finally, discuss things with your financial advisor before acting. So one of our roles as your advisor is to act as a sounding board and help you avoid impulsive decisions. Make use of the resource that you have available. So what if we don't address recency bias? I mean, hopefully I've convinced you that it's important, but nevertheless, let's talk about the cost of ignoring it. So for one, you could be overexposed, and this is where I mentioned earlier about rebalancing being so important. So you can end up exposed to particular assets and seeing declines in your total wealth that's disproportionate to what should have occurred had you remained appropriately diversified. And this could happen at a particular investment. So for instance, a disproportionate amount of your wealth was in, crypto or something, and then it dives in value and, it really hurts far more than it should have. You might have intended it was only ever a small portion of your wealth, but over time it got to be a bigger portion and therefore had too much impact on your overall position. You can see it too with individual shares. I was speaking to someone just last week who their self-managed super fund now is just one single share. They've kind of got rid of everything else. But this share's roller coasted from being worth $1 a share to currently being worth 8 cents a share. And so, the wealth in their portfolio has obviously changed dramatically. So being overexposed is definitely a problem of recency bias, or a potential problem, and it can be addressed through rebalancing. Missed opportunities is another one. So recency bias can lead to you selling during downturns, and then that means that you miss out on all the gains on the other side. And most recently, we've seen that through COVID. Markets dropped there for a period of time, relatively briefly actually, and people that sold out and then sat on the sidelines have missed some absolutely wonderful years ever since. It's also extra stress. So constantly reacting to short-term events can create unnecessary stress and anxiety. Try and avoid that, have your investments automatic and basically leave them alone. Recency bias is a natural human tendency, but it doesn't have to control your financial decisions. By understanding this bias and implementing strategies to counteract it, you can safeguard your plans and stay focused on what truly matters, which is achieving your long-term goals. All right, well, thanks for listening. Be sure to check out the Gaining Choice email on Friday to stay abreast of what's going on in the investment world. If you're not currently receiving that, if you visit our website, which is guidancefs.com.au, you can easily add yourself to the list there. All right, bye for now.